How do professional traders use fair value gaps to identify high-probability trade setups? The answer is not by treating them as standalone entry signals. Instead, they combine fair value gaps with liquidity, price action, market structure, and institutional confirmation to build complete trading strategies for different market conditions. Welcome back to the ComLucro channel. In this masterclass, you'll learn 5 professional fair value gap trading strategies inspired by smart money concepts and ICT. By the end of this video, you'll understand how professional traders trade fair value gaps using liquidity, price action, session timing, and momentum to make more structured and consistent trading decisions. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. Before we move into the 5 strategies, it is important to quickly review what a fair value gap is. We already have a complete fair value gap masterclass here on the channel, where this concept is explained in much more detail. And I will leave the link in the description and also in the card. But for now, let us briefly revisit the foundation so every strategy in this video makes sense. Fair value gaps are typically formed within a 3-candle sequence and are easy to spot on the chart as a large candle. The key characteristic is that the upper and lower wicks of the surrounding candles do not fully overlap the body of the middle candle. This creates what we call the fair value gap zone, which fills the empty space between the wicks and is drawn based on the body of the middle candle. There is one exception, where a 4-candle sequence must be considered to identify a valid fair value gap. When the first candle in a 3-candle sequence is an inside bar that forms within the range of the previous mother candle, we need to analyze a 4-candle sequence to mark the correct zone. In situations like this, if we ignore the mother candle when drawing the fair value gap, the result will not be accurate or optimized. For example, in this case, if we focus only on the 3-candle sequence and disregard the red mother candle, the identified gap would be incorrect. These concepts also apply in bearish markets. It's important to remember that these principles work across different timeframes and on any price action-based chart. Now let us look at the theory behind fair value gaps. Consider a 3-candle sequence as shown. Let us assume that this bullish sequence, which created a strong imbalance, formed on a higher time frame. To understand it from a market structure perspective, let us zoom into a lower time frame. Here we can see that price built a bullish structure, similar to the one illustrated. As mentioned earlier, the market consistently tends to fill and rebalance the gaps it leaves behind. Now, let us take a closer look at the logic behind this behavior. As you can see, price created a series of bullish movements to the upside, with strong momentum caused by heavy buying pressure and a lack of sellers. When traders see sharp movements like this and miss a good entry, they often place buy limit orders below key zones, such as order blocks and demand areas, hoping price will pull back deeply to trigger their orders before pushing higher again. This behavior accumulates many pending buy orders in that region, forming a large liquidity pool waiting to be swept inside the fair value gap. So traders, fair value gaps often contain many buy or sell orders, creating significant liquidity inside the zone. This is the main reason why price tends to return, fill the gap, and then continue with even greater strength. The presence of these pending orders acts like a magnet that pulls price back to fill the void before the trend resumes. This can offer a strong trading opportunity for us. But to use fair value gaps correctly, we cannot treat them as isolated zones. The best setups appear when the gap is connected to liquidity, direction, and confirmation. So let us begin with the first trading model. This strategy is built around 3 core components: a draw on liquidity, a liquidity grab, and the entry itself. For this setup, Two timeframes are used to execute the trade. On the higher timeframe, key liquidity levels are identified and a clear draw on liquidity is defined. From there, we move down to the lower timeframe. At that level, the goal is to spot a liquidity grab that aligns with the direction of the draw on liquidity. Once that occurs, the trade is executed, and both the target and stop loss are set accordingly. Before moving to the charts, it is important to note that this trading plan is not restricted to a single time frame. That said, the entry time frame should always be 2 time frames lower than the higher time frame. Based on your trading style, there are 3 time frame combinations you can apply. As an example, when using the 4-hour chart as your higher time frame, the 15-minute chart should be used for trade execution. Now, I will walk you through how this looks directly on the price chart. The first step is to identify a draw on liquidity on the higher time frame. But what does a draw on liquidity actually mean? In simple terms, it refers to recognizing a key liquidity level that price is actively moving toward. More often than not, the market is drawn to areas where liquidity is resting, such as equal highs, equal lows, or strong reversal points, because these zones contain a concentration of stop losses and pending orders waiting to be executed. These liquidity levels should always be marked manually on the chart. In this tutorial, the focus is on reading raw price action and applying smart money concepts without the use of indicators. By marking these areas yourself, you gain a clearer understanding of how liquidity forms and how price behaves around it. The next step is to zoom into a lower time frame and look for a liquidity grab that aligns with the direction of the draw on liquidity. With that in mind, let us move down to the lower time frame. Keep in mind that buy-side liquidity is positioned above current price. With that context, the objective now is to see a swing low taken out. In other words, we are looking for a bullish liquidity grab, which suggests a potential continuation to the upside. On the chart, this type of liquidity grab is identified directly through price behavior. A bearish liquidity grab occurs when price trades above a previous high but quickly falls back inside the range. This shows that buyers failed to hold higher prices, and that price was immediately rejected, pointing to bearish momentum. After this kind of move, a stronger push to the downside is often expected. In contrast, a bullish liquidity grab forms when price trades below a previous low and then rapidly returns back inside the range. This indicates that sellers were unable to sustain lower prices and that the market rejected that downside move, signaling bullish momentum. Once a bullish liquidity grab has been identified, the trade can be entered as soon as price returns inside the range. A more conservative option is to wait for price to continue moving higher to confirm the reversal, and then look for fair value gap formations to place a buy limit. If no clear fair value gaps are visible on the 5-minute chart, dropping down to the 1-minute chart can provide additional precision. Now, let us begin with a brief recap of the bearish setup. In a bearish scenario, the first task is to identify a key liquidity area that price is moving toward. This may be a previous low or a level where a large number of stop losses are clustered. These zones tend to draw price in before a reversal takes place. Once that area is defined, move down to the 5-minute chart. At this stage, wait for price to push above a recent swing high and then quickly return back down. This behavior indicates that liquidity has been taken and that the market may be preparing to move lower. After this confirmation, enter a short position and place your stop loss above the high created by the liquidity grab. Allow enough room for price to fluctuate and avoid placing the stop too tight. For your target, focus on the next clear sell-side liquidity level. This approach keeps the trade structured and intentional. Now, let us move on to the second trading setup. For this setup, 2 time frames are used to execute the trade. The 1-hour chart serves as the higher time frame, while the 5-minute chart is used as the lower time frame. On the 1-hour chart, the focus is on analyzing market structure to determine the overall trend. Look for breaks of structure and changes in character to define directional bias. Now, let me walk you through how this looks on the price chart. The first step is to determine market direction by identifying structural breaks and potential reversal signals. This is done by reading price action directly on the chart. By marking breaks of structure and changes in character, we can clearly define the prevailing trend. In this case, price is breaking structure to the upside on the 1-hour chart. That tells us the market is in an uptrend, so our focus remains strictly on buying opportunities. The next area of interest is fair value gaps. These gaps represent price imbalances, where the market moved too quickly and left inefficient pricing behind. Over time, price often revisits these areas as it seeks balance. We treat these gaps as key zones of interest, where reactions are likely to occur. The process is simple. First, wait for price to return into the fair value gap. Then look for confirmation on the lower time frames before executing a buy trade. At this point, we switch down to the 5-minute chart. On the lower time frame, the final step is to watch for signs of a potential reversal. One of the strongest clues is the appearance of a bullish liquidity grab pattern. This behavior shows that sellers were unable to push price lower, pointing to growing bullish momentum. If the next move also produces a change of character, that adds an extra layer of confirmation to the setup. With those conditions in place, the trade can be executed. The stop loss is placed below the low created by the liquidity grab, while the target is set at the next significant level on the higher time frame. The same logic applies in a bearish scenario. Begin on the higher time frame by identifying the overall trend. In this case, price is forming lower lows and lower highs, which confirms a downtrend, meaning only sell opportunities are considered. From there, fair value gaps are marked as potential supply zones. When price retraces into one of these areas, drop down to the lower time frame and wait for a bearish liquidity grab to form above a recent high. After confirmation, enter the trade. The stop loss goes above the liquidity grab, and the target is aimed at the next key level below. With all of this in mind, proper risk management is essential to protect your capital. Follow your trading plan and avoid emotional decision-making. Be patient, wait for high-quality setups, and never risk more than 2 to 3% of your account on a single trade. Now, the third trading strategy also relies on 2 time frames and brings together the concepts of buy-side and sell-side liquidity, liquidity sweeps, and fair value gaps as the entry framework. So, what do buy-side and sell-side liquidity actually mean? Liquidity sitting above a high or a series of highs is considered buy-side liquidity, while liquidity resting below a low or a group of lows is defined as sell-side liquidity. What typically happens around these areas? Institutional participants, often referred to as smart money, actively target these liquidity zones. For instance, when smart money intends to build long positions, a large number of sellers is required to fill those buy orders. That raises an important question. Where are those sellers located? When price approaches a key support level, many retail traders and sometimes institutions enter long positions. Their stop losses, which function as sell orders, are usually placed below that support area. To access that liquidity, smart money drives price lower to trigger those stop losses and collect sell-side liquidity. This process provides the necessary selling pressure to fill large buy positions. At the same time, the break below support often attracts additional sellers who believe price is about to continue lower. In many situations, once that liquidity has been taken, price quickly reverses and moves higher. This reaction traps both early buyers and traders who sold the breakout. The same principle applies in the opposite direction with buy-side liquidity. When smart money is looking to sell, buyers are needed. To achieve this, price is pushed above a key resistance level, triggering buy-stop orders and breakout entries, before reversing lower after sufficient liquidity has been gathered. With that in mind, not all liquidity levels carry the same importance. Certain conditions make some levels more reliable than others. Liquidity formed around major swing highs and lows, higher time frame levels, or areas where multiple equal highs or equal lows are present tends to be significantly stronger. Now, let me show you how the third trading strategy plays out on the chart. To begin, mark the buy-side and sell-side liquidity zones directly on the chart. After that, wait for price to move beyond one of these areas, and then quickly close back inside the range. This behavior represents a liquidity sweep or false breakout, where smart money has already collected orders and is likely positioning for a move in the opposite direction. From there, drop down to the lower time frame and identify fair value gaps that formed immediately after the sweep. These gaps highlight price imbalance and can be used as potential entry zones. In a bearish scenario, for example, after price sweeps above a buy-side liquidity level, look for a fair value gap along with signs of reversal. Once confirmation appears, a short trade can be taken. The stop loss is placed above the high of the sweep, while the target is set at the next key level or sell-side liquidity below. The same logic applies in a bullish scenario. In this case, the focus is on sell-side liquidity resting below key lows. When price sweeps that level and closes back inside the range, it signals a bullish liquidity grab. Next, move down to the lower time frame and wait for a bullish fair value gap that forms immediately after the sweep. This gap serves as the entry zone. Enter a long position from the gap, place the stop loss below the swing low, and target the next buy-side liquidity level. This straightforward process allows you to trade alongside smart money rather than against it. Keep in mind that taking more trades does not automatically lead to higher profits. Developing the patience to wait for high-probability setups and filter out low-quality opportunities is a skill that requires both time and discipline. So far, every strategy we have covered can be applied across different markets and time frames. But fair value gaps can also be used within more specialized trading models. One of the best-known examples is the ICT Silver Bullet, which combines session timing, liquidity, market structure, and fair value gaps into a precise intraday framework. The Silver Bullet is an ICT trading strategy that combines three main concepts: market structure shift, liquidity sweep, and fair value gap. When these elements align within specific trading sessions, they create a structured opportunity based on liquidity and confirmation rather than random entries. To trade the Silver Bullet, wait for price to break above the day's high during the London or New York session, and then quickly return inside the range, taking out the buy-side liquidity. This movement above a key intraday level attracts breakout traders, but the fast return inside the range signals that liquidity has been collected. This liquidity sweep above the key structure of the day suggests that a potential reversal may be forming, especially when it occurs during high-volume session times. Next, we wait for a bearish market structure shift to confirm this potential reversal. A bearish market structure shift happens when price breaks and closes below the most recent swing low. This shift indicates that buyers are losing control and that selling pressure is beginning to dominate. In other words, demand is no longer in control, and price may start pushing to the downside with stronger momentum. Then mark the bearish fair value gaps that form during the displacement move as potential supply zones. These imbalances often act as retracement areas where institutions rebalance positions. Set a sell limit order at the beginning of the FVG zone and wait patiently for price to pull back into that area. If new fair value gaps form as price continues to move, you can map out future opportunities. But always follow a clear and disciplined risk management plan to protect your capital. Similarly, in the bullish scenario, the logic simply inverts. Wait for price to sweep liquidity below the day's low during the London or New York session. A valid liquidity sweep pattern forms when price breaks below a key level and then immediately returns back inside the range, signaling that sell-side liquidity has been taken. Next, wait for a bullish market structure shift to confirm that the reversal is valid. Finally, mark the fair value gap created during the displacement and plan your entry accordingly. If the fair value gap is relatively small, remember to use a slightly wider stop loss to give the trade enough breathing room and protect it from normal market fluctuations. In conclusion, the Silver Bullet strategy is powerful because it forces you to wait for liquidity to be taken, confirmation to appear, and imbalance to provide the entry. Instead of chasing breakouts, you trade the reaction after liquidity is cleared. When executed with patience and proper risk management, it becomes a structured and repeatable intraday model rather than a random setup. Now, the Silver Bullet uses market structure shift as confirmation. But in some situations, the market begins to reveal a change in momentum before a full structural shift becomes obvious. This is where change in state of delivery becomes useful, because it helps us read how price is transitioning from control to execution after liquidity has been taken. If you understand how price transitions from control to execution, you can spot reversals earlier and enter with much better risk to reward. That is where the difference between change of character and change in state of delivery becomes critical. These two concepts explain not just where price breaks, But how momentum and control actually change behind the scenes? A change of character occurs when price begins to lose its previous structural control inside a broader swing. This process usually starts from a deeper pullback of the prior move, where price retraces 50% or even deeper of the swing. From this pullback, price develops a more complex movement, with both the expansion and the retracement containing several candles. This reflects a gradual transition phase, where control is weakening, but price delivery is still inefficient. The key role of the change of character is structure, not speed. It highlights that the prior directional bias is no longer dominant. A change in state of delivery focuses on how price is delivered rather than on structure itself. CISD typically appears after a liquidity sweep and is characterized by a sharp and efficient expansion, preceded by a short and shallow retracement, often around the 38.2% level. Both the expansion and the pullback usually involve very few candles. This reflects a sudden shift in momentum, where price moves with clear intent and efficiency. CISD signals that the market has transitioned from distribution or accumulation into active execution. In practical terms, CISD often appears before full structural confirmation. It provides an early indication that a reversal may be unfolding, especially when it occurs immediately after liquidity has been cleared from one side of the market. When combined with concepts such as liquidity sweeps and fair value gaps, CISD improves trade quality by aligning entries with momentum and institutional price delivery. Now let's get started. So what exactly is the change in the state of delivery? The change in the state of delivery, CISD, is a reversal pattern in which the price's momentum and delivery shift directions suddenly. In this example, you can observe a clear bullish trend. These three candles represent the most recent bullish delivery, showing strong and efficient momentum, which has pushed price above a recent structural level. This can also be referred to as the most recent buy-side delivery. Some traders mark the candle open as the CISD reference. In our approach, CISD is marked at the pullback extreme, just like change of character and break of structure, using the highest point in a bearish scenario and the lowest point in a bullish scenario. At this stage, the structure still appears bullish, and after a short-term correction, price would normally be expected to continue pushing upward. However, if price suddenly shifts behavior and delivers a strong bearish move, closing below the demand area and invalidating the prior bullish delivery, this condition is known as a change in the state of delivery. So what does this signify in terms of price action? First, it suggests that the breakout may have occurred to engage liquidity above this market structure level, rather than to sustain continuation. The buy-side delivery triggers buy-side liquidity, which can then be followed by a bearish shift in delivery. A break below the demand level shows that buyers are no longer supporting price with the same efficiency, while sellers have begun to deliver price more aggressively. This change in delivery signals a potential transition toward a bearish phase. So how can we use this concept to enter a trade? At this point, the short-term market bias begins to shift to bearish, meaning we prioritize sell opportunities while still monitoring structural confirmation. After observing a break and close below the origin point of the prior buy-side delivery, we recognize that this area may now act as resistance. While this does not by itself confirm a full structural reversal, it provides an important area of interest. When price pulls back into this zone and bearish delivery continues, it can present a high-quality opportunity to enter a short trade. Since this zone previously acted as support and is now showing resistance behavior, the probability of rejection and continuation to the downside increases. Entering a short position from this area allows participation in the emerging bearish momentum with a favorable risk to reward profile. It is important to remain patient and wait for price to return to this area before entering the trade. This patience improves execution quality, reduces risk, and increases the likelihood of capturing a sustained downward move rather than reacting impulsively. The same concept applies to the bearish scenario. However, it is important to note that not every change in state of delivery observed on the chart will lead to a successful trade, especially if it occurs without clear context, liquidity interaction, or directional relevance. CISD on its own only describes a change in delivery, not a guaranteed reversal. To trade CISD effectively, it must align with other market factors and conditions. Through backtesting, we've observed that CISD patterns are most effective when they appear within a well-defined market context. To qualify a high-quality CISD and prepare for a strong trade opportunity, certain conditions should be present. Let us now discuss the key factors that enhance the reliability of a CISD pattern. Rule number 1. Reaction at a higher time frame key level. As discussed earlier, CISD represents a shift in price delivery, and it becomes significantly more relevant when it occurs after price interacts with a higher time frame key zone. Key levels on higher time frames, such as the 4-hour, daily, or weekly, carry greater influence over price behavior. When price reaches these zones and a CISD forms, it suggests that delivery is shifting at an important area, increasing the probability of a meaningful move. Without higher time frame context, a CISD may still appear, but it's more likely to represent a short-lived fluctuation rather than a sustained transition. Rule number 2. Sweeping a liquidity pool. A high-quality CISD setup often occurs after the market sweeps liquidity from one side. Liquidity pools form around obvious equal highs and lows where traders place stop losses. When price sweeps these levels, it engages resting liquidity and creates the conditions for a potential shift in delivery. Once this liquidity is taken, price is more likely to transition into efficient movement in the opposite direction, making it an ideal environment for a CISD to appear. This does not confirm a reversal by itself, but it strongly increases the relevance of a CISD by showing that liquidity has been cleared and delivery conditions have changed. Rule number 3. Volume and confirmation. For a valid CISD setup, it is important to observe an increase in activity during the shift in price delivery. Higher participation reinforces the efficiency of the move and supports the change in momentum. Entering a trade based on CISD without this confirmation can be risky, as it may reflect a weak or short-lived change in delivery. This increase in activity is often visible through the formation of fair value gaps. Fair value gaps appear when price moves aggressively, creating imbalances that reflect strong directional intent. When a CISD forms alongside a fair value gap, it suggests that large participants are actively delivering price, adding credibility to the setup. A retracement into the fair value gap can offer a high probability area of interest, as price often revisits these imbalances before continuing in the direction of the new delivery. Combining CISD with fair value gaps improves timing and reduces execution risk. Rule number 4. Waiting for the pullback to the reference level. After price breaks below or above the origin point of the prior delivery, it is important to wait for a retracement. This pullback allows traders to evaluate whether price accepts the new state of delivery. Rather than viewing this strictly as a structural flip from support to resistance or resistance to support, the focus should be on how price behaves when it revisits this area. Acceptance or rejection during the pullback helps confirm whether the new delivery is likely to continue. Entering on the pullback improves your risk-to-reward ratio and provides clearer information about whether the new state of delivery is being accepted. By following these rules, ensuring the CISD occurs at a key level, observing participation and delivery confirmation, and waiting for a retracement, you increase the chances of identifying high-quality trade setups with strong potential while controlling risk. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the ComLucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts, it's about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.